Well, good morning, traders and investors. Today is March 2nd. It is a Tuesday. It is the second trading week of March. Let's start with the global economy, which right now, if you look at the futures, they're a little bit down, but nothing crazy, not like the 150-point swings on the NASDAQ we've been seeing. The market's going to open up in about an hour and 20 minutes, and futures are just slightly lighter. NASDAQ down about 8 points. S&P down about 3 points, Dow about flat. This doesn't really go one way or the other, so I wouldn't really make what the market will do today based on the futures that we're seeing right now. This is just really random trading action. As far as the news, we don't have a lot of data today. Tomorrow, we got the petroleum status report, we've got the PMI. The big reports come out Thursday: jobless claims, productivity costs, factory orders, and international trades in goods and services, and employment situation. That's coming Thursday and Friday. And yesterday we had the ISM manufacturing index, which showed that manufacturing was better than expected. Now, looking at the global economy, let's start with the global economy. But as I go through the global economy, I want to talk about bonds because it's a lot of it has to do with the bond market. The bond market freaked out and went down. When the bond market goes down, when the long-term bond market goes down, interest rates go up. Bonds go down, interest rates go up. Why? Because remember, what is a bond? It's an IOU, and it has a fixed sum. So that sum has to get there either through the bond price or through higher or lower interest rates. So as interest rates go up, bond prices go down. As bond prices go up, interest rates go down, because they always have to make that par value. Like the 10-year note, par value futures is a $100,000 note if you were to hold it 10, 20, 30 years. But the bottom line is the interest payments you're getting, they are an IOU. So remember, the fixed amount at the end is always the same. The maturity is the same. So at the end of the IOU, so you have to adjust the bond via the yield via the bond. One goes up, one goes down. So bonds are opposite. So when we saw the bond market go from the 152 level to the 141 level, we saw interest rates go from about 1% to about 1.5%. And that caused the market to get a little scared. That's where we're at. So when I talk about the global economy report right now, keep in mind what I'm talking about. And this little reaction here caused rates to go higher and caused investors to worry. But if you look at it over a 10-year period or a 20-year period, you will see that this isn't really anything major. There's nothing really that crazy here about the bond market. I mean, a few years back, we were at a lower rate. We're at a higher rate. So this isn't anything crazy when you're looking at the long-term rate of interest rates. But over a period of a few weeks, look at this. This is from November till March, or a few months, excuse me. We were here all the way, 1.5. Now we're in, so about 2 months ago. In over 2 months, interest rates went up 50%. But yeah, 50%, but we're still at 1.5%. So just keep that in mind as I go through the global report. Now, global stock market and Wall Street futures declined Tuesday. Not really, after a sell-off in the U.S. Treasury bond eased, helping to alleviate any concern about a possible rise in interest rates. I think interest rates are going to go up, but I mean, honestly, we're going to bounce up, hover around this area. And I think by the end of the year, we'll be at 2.5%. And the stock market currently is taking in its value about 3.5%. So I wouldn't worry about it too much. And in another video, I'll show you how the stock market calculates yield versus the 10-year note. It's a whole different video, but I'll do it for you. So overnight, Wall Street benchmark S&P climbed 2.4%, recovering most of its losses from the past week. That came after Treasury sell-off abated. That's what we were just talking about, after pushing yield to the highest level in a year. Yes, 1.5%. That helped to dampen the concerns about a possible rise in interest rates and downwards pressure on the U.S. economic recovery. I think it's just a bounce. I wouldn't go that far. But interest rates are going up, folks. There's just no doubt about it. Meanwhile, Japan reported employment rose despite state of emergency to cope with renewed coronavirus outbreaks, and South Korea reported higher factory output. The news from the East has been pretty stable. From China, from South Korea. So the news has been somewhat stable. And from Japan. Japan is actually moving a little higher. And it looks like if China and Japan can get out of this COVID mess like U.S. is trying to get out, I think we'll be okay. Fingers, toes crossed. Yield on the Treasury note, of the difference between its market price and the payout at maturity, fell to 1.43%. On Tuesday, it declined even further. That's this right here. That's what we're talking about. As this goes down, as the bond market goes down, yield goes up. So it's right now fluctuating. But again, if it doesn't break down the low, we should be okay. But if it breaks down this low, interest rates are going higher. Remember, there's an inverse relationship between bonds and interest rates. Bonds go down, interest rates go up. A lot of people find that hard to understand, but it's just inverse. Stocks turned lower in late February after a rapid rise in bond yield caused by a fall in the market price fueled inflation concerns. That's right. When long-term rates go up, it fuels the fact that money will be worth cheaper, will be able to buy less in the future. The yield on the Treasury, 10-year Treasury, climbed as high as 1.5%. Again, that's what we're talking about right here, and now it backed off a little bit. Bond yield influences rates on mortgage and other borrowing. And folks, yes, 1.5% is still really, really low. So let's not get, let's not get carried away here. And Jerome Powell, he speaks on Thursday, and he's going to tell us how he's going to keep short-term rates near very, very low levels. But if short-term rates stay low and if long-term rates go higher, it's just signs of inflation. So we're going to hear Powell talk about that. That's happening on Thursday. Let's see here if we see it even on our calendar. Fed balance sheet, but I'm not really seeing him on the calendar. But if he's going to be speaking on Thursday, he's going to be speaking on Thursday. And we're watching Washington. House of Representatives approved Biden's $1.9 trillion aid package. Send it to Senate, includes one-time payment to the public and aid to struggling businesses and local governments. And that should do a really good job picking up retail sales. And if retail sales can pick up between now and the time that most Americans can get that vaccine, which is only a couple of months away, we should be in good shape. But we need to see it come out. And Johnson & Johnson also approved the company's COVID vaccine, which is different than Moderna and Pfizer's because it only allows one shot, doesn't need refrigeration, and doesn't need 15-minute wait time to see if you start growing horns, or I'm just joking around. But you know what I'm getting at. So this is going to be a game changer, I'm hoping. Now, looking at the indices, we're, again, not really anything going on right now. If you look at the S&P, we are now trading above the 50-day moving average. Yesterday, we were completely above the 50-day moving average. If we are completely above the 50-day moving average today, then I would expect the S&P to be bullish. But I would say it is pretty bullish because even the day before, we barely went down. Yesterday, we went up, and today we're above. So unless something really crazy happens today, I would consider the S&P to be bullish. But the NASDAQ is a whole different story. The NASDAQ is just now getting out of this zone. And while yesterday the majority of price action was above the 50-day moving average, some part of it touched the 50-day moving average. And that means no soup on the NASDAQ 100. Remember, I want to see two, not one, but two complete days where it's trading above the 50-day moving average and does not touch it like this bar right here. I want to see two bars like this. I want to see a bar like that. I can't see any of these bars. This one is below, completely below and not touching it, but that's not what we want. We want to see it above and not touching it. When it's above for 2 straight days without touching the bar, that's giving us an indication that the market is coming back. And if we look at the Russell 2000, we will see that it's more bullish than the rest. It's not even close to the 50-day moving average. So the S&P, so if you were to look at bullishness to bearishness, Russell is the first, S&P is the second, NASDAQ is the third. And let's see where the Dow falls in there. We want to look at the Dow, right? Yeah, the Dow is probably. So it's Russell, the Dow, S&P, and NASDAQ, okay? Looking at the 10-year, we're still grossly bouncing. This is a bounce from oversold territory. And whether interest rates are going to go up or not, I think this is just a technical bounce. And I wouldn't be surprised if we went a little higher, maybe to the 145, maybe to the 150 level before reverting back down. But folks, interest rates are going to go up and bonds are going to go down. It's just the way it is. We can't keep interest rates, long-term rates at 1.5% that much longer. It's just not going to happen. Now, looking at the sectors, yesterday I was talking about beginning of this week when the market cooled off, that usually causes fragmented sectors or sectors that are out of whack to come back to reality. So we had it pretty good. We had energy and financial, and then we had industrial and basic materials, and then we had technology and consumer discretionary. But the market started going higher, and tech is starting to move up. Now, I like tech right now. I like it, but I would prefer to look at smaller tech companies. not larger tech companies. With that said, there's still one sector that I really like in technology, and that's the semiconductor sector. But otherwise, look for slightly smaller tech companies. Right now, Till Tech is a little higher up. And I think what we're going to see is we're going to see technology and consumer discretionary start coming up, because remember, that aid that the government is going to give us, that $1.9 trillion and a one-time payment, you see this one-time payment? Well, that one-time payment is going to go towards consumer discretionary. Sony video games are coming out. The summer's coming up. A lot of people are itching to spend a little money, vacations. So I see money starting to come back into consumer discretionary and tech. So I'm expecting consumer discretionary and tech to start moving a little bit higher right now, especially while the bond market is bouncing, is technically bouncing back up. That's going to give tech a little more of a lifeline. Now, with that said, there's 3 stocks that I like right now that are breaking out pretty good. First one, DraftKings. Now, DraftKings, if I remember correctly, it's a smaller stock. The stock is only worth about $26 billion. That is not a big stock. It's not like Amazon or Microsoft or Apple. So it's a mid-cap, small to mid-cap stock. The stock is up 328% this year. If you look at the stock, and DraftKings is gambling, online gambling stock, it's breaking out. Finally, it made an all-time high early October. It finally has been congesting, going a little higher, and finally it's breaking out higher. I believe this is an all-time high. Yes, it is. And I like DraftKings. I think the stock has a lot to go. I think last year was just the beginning of this, and people love gambling. They like playing. If you look at what the stock does, sports entertainment, sports betting, sports game, sports fans. People can't go to sport games right now, or most people can't go to sport games right now. So DraftKings, playing sports games online, is the next big thing. Big stock, has a lot of upside, one of the top stocks in its field. Next one, Citigroup. Now, I've been very cautious on Citigroup lately, but the stock has been going higher. And if you look at this price right here, you will see that the price of the stock right now is higher than the February high. Now, remember what I said, I want to see stocks that are trading above the February high, above the level that they broke down. And Citigroup broke down right around this level right here, right around the 73 level, and it looks like it's reaching for it right now. So I'm kind of neutral, but I am thinking that the stock is starting to go up along with the rest of financials, and Citigroup is one of the big stocks. So I would be very cautious. I would wait for a pullback to the 63 level if you're going to go long. But I do like Citibank, and I like the fact that it's taking out over a one-year high. It's trading over a one-year high, which is material. And also, remember, on the NASDAQ, we saw a lot of the stay-at-home stocks. Not the stay-at-home stocks. We saw a lot of the going-out stocks like Trip, Expedia, Marriott, Ulta Beauty Supplies, even Rick's adult entertainment nightclub. Is moving up. That's right. There's a nudie bar that's a public company, ticker symbol RICK, R-I-C-K. See, I gave you a freebie today. Jesus. Anyway, so the bottom line is Citigroup is going up. I like the fact that some of the stocks that were hidden, that just didn't go anywhere, are starting to move up. And the fact that those stocks like Trip, Marriott, Expedia, Rick's, it means people are starting to look back towards going out, regular stocks. And bank stocks like Citigroup are definitely in that group. Last stock that I like is Micron. Now, I know I'm a little neutral on tech right now, but I love this stock. This is one of the top semiconductor stocks. It's been doing nothing but breaking the trend higher. It's a DRAM stock. It's one of the biggest semiconductor companies in the world. World's leading provider of advanced semiconductor solutions. See, DRAM? DRAM is hot right now. Hot in cars. I mean, super hot in the self-driving cars, disruptive cars. We need all the DRAM we could use for driving mobiles and self-driving cars, autonomous car, and so forth and so forth. 1 year return for a semiconductor company, 800%. 5-year return, 735%. And yes, technology is going up, but look at semiconductors. Look at the semiconductor index this entire time. This thing's been cooking with gas. Hasn't really pulled back. Look at this. No pullback. Still above the 50-day moving average. I like chip stocks, and Micron is one of my favorite ones. I like Micron a lot, and I like Applied Material. Let me show you this one too. There you go. They're both doing the same thing, AMAT and Micron. So again, DraftKings, Citigroup, and Applied Material. Why? Because the S&P and the Dow are starting to make a comeback. The Treasury notes are bouncing higher, which means lower interest rates for the foreseeable future. Don't hold your breath. It's not going to be that long. But it looks like stocks are starting to make a little bit of a comeback. And Fed data is positive. Third vaccine is out. People are starting to look forward to going out again. It's time to see if some of these stocks will move. Now, DraftKings was a very, very popular stay-at-home stock, but it doesn't mean it can't be a very popular stock when economy comes back to normal. And Citigroup, same thing. Applied Material and Micron, well, they've been hot all along. Now, folks, before I let you go, I've got something important for you. I found a way to spot 3, 5, even 10-time gainers in less than a month's time by targeting microbursts on some of the market's most explosive stocks. Microbursts are quick, punchy moves in small cap stocks like this DraftKings stock. And what did I say? Russell is still leading. And once started, can return triple-digit gains in a matter of days. In fact, I recently signaled a 414% return on CNE stock in under 1 week. And now I'm ready to discuss how I find these little-known microbursts with you. All you've got to do is click the link below to learn which stock I'm targeting next. Also, make sure to like this video, subscribe to this channel if you're watching on YouTube, and stay ahead of the market by being the first to be notified when we post our next video. And remember what I showed you. Remember when we were talking about each index? I was showing you the strongest one, and guess what the strongest one was? The Russell, that's small caps right there, followed by the Dow, followed by the S&P, followed by the NASDAQ. So the strongest gains right now are still in the Russell. Let me show you something cool about the Russell. You're going to flip out when I show you this. Look at this. These are Russell stocks. Look at the top gainers, how much they've returned in the last 6 months. This is 7,000%, 3,500%, 2,600%, 900, 930, 720, 682, 6-month highs. 6-month returns on the Russell. Look at this, going all the way down. We're still at 341. Now look at the same thing for the S&P, 167%. What would you rather have, 8,000% or 167%? That's the power of the Russell. Follow the link below. Check out these microbursts. Learn how you can make 414% in just a few days or maybe a week on CNE stock. 7 days, 414% return. You got to check it out. Follow the link below. And most importantly, have an amazing day. Talk to you soon. Post some comments and feedback for me. It's been a while. I want to hear from you. Bye, guys.